It's an out of consensus view. Obviously, the market is clearly quite exuberant about the economy, and the optimism is, in our view, misplaced. And that really hinges on the outlook for inflation, which is proving extremely sticky and entrenched, particularly on the services front. And this is where we think there's more work to be done from central banks in order to bring inflation lower. This is not going to come down on its own. The labor market is still very tight. There's a lot of imbalances on that front, a lot of demand chasing too little supply. This, of course, is propping up wages. That is the sticky part of inflation that is not going to come down on its own. The Federal Reserve, central banks everywhere need to apply pressure to create some demand destruction in order to bring that inflation down, core inflation down, to more comfortable levels. And that, of course, is going to result in some economic fallout in the form of a recession, in our view.
Yeah, and just in terms of the fallout, in terms of what that's going to do to various asset classes as well. Again, NASDAQ, I think, up somewhere in the region of 36% this year. S&P up around about 17%. And we know there's been some very specific drivers. But it's interesting. It's actually broadening out now, the rally, having been very specific for a large part of the year.
Yeah.
What is your scenario, your base case scenario, going to do to equity markets?
Yeah, the base case, regrettably, is quite gloomy. And not surprisingly, if we're pricing in that recession, you're going to see an earnings contraction. Again, I think earnings expectations are still probably overly buoyant given that outlook for slowing growth. So there could be some vulnerability there. And of course, on the valuation front, I know we talked about, the 7 stocks that have been driving the S&P 500 this year, really bringing into question the actual strength of the market. Like, is it maybe overstating the strength of the market? And on that front, we think, that given interest rates are moving higher or are expected to move higher than the market definitely is pricing, this is likely to weigh on PE multiples. So you're sort of getting hit on both sides on that front in that deep recession scenario that is our high probability scenario at this time.
I want to just pick into this deep recession scenario a little bit more. I mean, how do we get there? The market thinks we've got a rate hike in July, another follow-up potentially in November. Is that enough in itself to trigger a recession, in your view?
No, and I mean, that's the optimistic scenario, that the Fed maybe is done after July and avoids outright contraction. That's our second scenario. That's the stagflationary scenario, where you have higher inflation, they're willing to live with it for longer, but growth is slowing. It's not ideal, but it's better in magnitude versus a deep recession.
So how many rate hikes do we get in your view then?
We're going to 6% on the Fed funds, so probably 3 more from here. And that is where...
Three more in 2023?
Exactly. And that is where we obviously differ from the market. And we believe that interest rates not only need to move higher, but they need to stay there for longer. And that's something that is not yet priced in either the fixed income or the equity market.
So why can't we just see what the market expects, which is 1 rate hike, potentially another follow-up one, but also a stretch of time? And Steve was pointing out these great stats this morning, from 15 to 18 months, the typical or the longer scenario,
board which just
of
shows
higher for longer.
From High Frequency Economics, just because it's a great board, and it just shows how long Fed stops at a higher level before it cuts again. And this is what I think that you're making, Candice, and this is the point Karen's making as well. In the last 30 years, the average hold lasts 11 months. Well, I looked at the CME Rate Watch, and they're calling us 1% lower from where we are now, rather than, or sorry, 1% lower from the peak rates that they think is going to be 5.6% as well, and let alone your 6% scenario.
Why can't this work for markets? Why can't we just have the next phase of monetary policy, which is a holding higher for longer versus a third rate hike?
So our view is really, again, hinging on that inflation outlook that we think is far too elevated. And like I said, the risks are to the upside. If the Fed does pause, the risk there is that inflation reaccelerates and they have to return to the tightening campaign. We've already seen that in a few central banks that tried to stop earlier this year, the Bank of Canada, Reserve Bank of Australia, I believe the Norges Bank as well, tried to pause, but inflation started to move up again, and then they had to come back.